In 2026, four companies, Amazon, Alphabet, Microsoft, and Meta, plan to spend roughly $725 billion building AI infrastructure. 1 year. That is up 77% from 2025, which was itself an all-time record, and analysts already expect the trillion-dollar mark in 2027. Against that, the most successful AI company on Earth, OpenAI, brings in somewhere between $20 and $25 billion a year. The entire frontier AI software business earns in a year what the build-out spends in a couple of weeks. Ask whether that gap makes this a bubble, and you get two confident answers. One side says this is the dot-com crash with bigger numbers. The other says these are the most profitable companies in history investing from cash flow. Here is the thing. Most people arguing about 2000 have never looked closely at what actually happened in 2000, so today we do exactly that and use it as a measuring stick. The answer is more interesting than yes or no. First, the measuring stick itself. On March 10, 2000, the Nasdaq peaked at 5,048, up roughly 400% in 5 years. Companies with no profits and sometimes no revenue were worth billions because the internet was going to change everything. Then, over 2.5 years, the index fell 78%. $5 trillion in market value evaporated. And here is the number people forget. The Nasdaq did not reclaim its 2000 peak until 2015. 15 years underwater. Cisco, briefly the most valuable company in the world, in March 2000, trading at well over 100 times earnings, fell more than 85% and took 2 decades to get close to its old high. The bitter joke of the era came from Sun Microsystems CEO Scott McNealy, whose stock had traded at 10 times revenue. He asked investors in hindsight, "What were you thinking?" Keep that phrase in your pocket. We will need it later. What actually died? Start with the mascots. Pets.com raised $82 million in an IPO in February 2000 and was liquidated by November, 9 months later, having lost money on every sale of every bag of dog food it ever shipped. Webvan burned through more than $800 million building automated grocery warehouses for customers who did not exist yet, and was gone by 2001. Hundreds of dot-coms followed the same script. Real idea, decades too early, or unit economics that never worked. Valued on eyeballs and clicks because there were no earnings to value. This is the part of 2000 everyone remembers, and honestly, it is the least relevant part today. The public AI leaders of 2026 are not Pets.com. They have the strongest balance sheets on Earth. If the comparison stopped here, the bulls would win easily. But the dot-com crash had a second act, and the second act is where the real money died. The deepest losses of the bust were not e-commerce websites. They were the companies building the internet's physical infrastructure. Telecom firms borrowed staggering sums, hundreds of billions of dollars, to lay fiber optic cable for a traffic explosion they were sure was coming. WorldCom went bankrupt in 2002 with $107 billion in assets, the largest bankruptcy in American history at the time. Its books propped up by outright fraud. Global Crossing, gone. Northpoint, Windstar 360 networks, gone. By some estimates, the telecom sector alone destroyed around $2 trillion in value. And the detail that should sound familiar, by 2002, the overwhelming majority of all that fiber, most estimates say 85 to 97%, was dark, unlit, cable in the ground carrying nothing. Demand was real, it just arrived years later than the debt payments. Infrastructure booms do not die from being wrong, they die from being early while leveraged. Now the twist we flagged in the electricity episode. All that dark fiber did not stay dark. It became the dirt-cheap backbone that made YouTube, Netflix, and the streaming era economically possible. The build-out was right. The builders went broke. Same story with the companies. Amazon fell 94% in the crash, from $107 to under $6. Priceline fell 99%. Both were left for dead. Both became giants, worth many multiples of their bubble-era peaks. This is the pattern that repeats across every infrastructure mania back to the British railway craze of the 1840s, which bankrupted a generation of investors and also gave Britain its railways. The technology was never the lie. The internet was, if anything, underhyped in 2000. The lie was the price and the timing. Hold both of those thoughts, because now we walk the same ledger for 2026. Here is what the build-out looks like right now. Amazon, guiding around $200 billion of capex for 2026. Alphabet, up to $185 billion. Microsoft, roughly $145 billion. Meta, somewhere between $125 and $145 billion, and raised mid-year. Add Oracle and the neo-cloud builders like CoreWeave and the number pushes towards 750. That money buys GPUs, custom chips, land, buildings, and above all power. The constraint we covered last week. To find spending this large relative to the economy, you skip 2000 entirely and reach for the railroads or the 1960s space program. And unlike the telecoms, this is mostly not borrowed money. These four companies generate hundreds of billions in operating cash flow from search, ads, cloud, and software monopolies that print money regardless of AI. That is the single biggest difference from 2000, and it is genuinely enormous. The people laying this generation's fiber can afford to be early, so I'd say, mostly. Now the uncomfortable column. OpenAI, the fastest-growing software product in history, ended 2025 around $20 billion in annualized revenue, and is reportedly spending on compute at a multiple of that. Anthropic, several billion and growing fast. Add every frontier lab together, and the AI software industry's revenue is in the neighborhood of 6% of 1 year of the infrastructure spend meant to serve it. Meanwhile, MIT researchers surveying enterprise deployments found roughly 95% of corporate AI pilots showing no measurable return yet. None of this proves AI is fake. ChatGPT has hundreds of millions of weekly users and real exploding usage. It proves the bet is on future demand, not current demand. Which is exactly what the fiber baron said, truthfully, in 1999. The demand came. It just came after the margin calls. The question is never whether the future arrives, it is whether the financing survives the wait. And there is one 2000 rhyme that deserves its own slide. In the late 90s, equipment makers like Lucent and Nortel lent their telecom customers the money to buy Lucent and Nortel gear. Sales looked spectacular right up until the borrowers collapsed and the sales turned out to be a loop. Now look at 2026. Nvidia investing tens of billions in OpenAI, which commits to buy Nvidia chips. OpenAI signing hundreds of billions in compute contracts with Oracle, which borrows to build data centers full of Nvidia chips to serve OpenAI. Microsoft invested in OpenAI and gets paid back partly in Azure spending. Every deal is defensible alone. Together, the same dollars circle between a handful of companies, and everyone's revenue is everyone else's cost. Watch one more accounting tell, some operators quietly stretching GPU depreciation schedules to 5 and 6 years, flattering current earnings on hardware that may be obsolete in 3. That is not fraud. But it is exactly the kind of thing McNeely meant. Time to answer honestly. Is AI real? Emphatically yes, more real than the internet was in 2000 by any usage measure. Revenue growth at the leaders is faster than anything the dot-com era produced. Are parts of the ecosystem priced for perfection? Also yes. The history lesson is that these are not opposing answers. The railway mania built the railways and wiped out the investors. The fiber glut bankrupted the telecoms and enabled streaming. Transformative technology and devastating bubble are not opposites. Historically, they are roommates. If 2000 teaches one thing, it is that the crash and the revolution both happened in that order to different people. The dot-com bust did not kill the internet. It killed the people who paid 2000 prices and needed 2000 timing. So the practical question was never, is AI a bubble? It is, which side of that sorting am I on? And what would tell me the sorting has started? 5 signals, all public, no crystal ball required. 1. The gap. AI revenue must grow into the capex. Watch whether frontier lab revenue keeps roughly tripling or starts merely doubling while spend accelerates. 2. The funding source. The moment the build-out runs on serious debt instead of cash flow, and Meta and Oracle have already issued tens of billions in bonds, the telecom clock starts ticking. 3. Depreciation. Companies lengthening chip lifespans in their accounting are borrowing earnings from the future. 4. The deals. When vendors finance their own customers at growing scale, count the loop's real outside revenue. 5. Capacity honesty. Watch for the first hyperscaler to cut CapEx guidance. In 2000, the first cut was the Avalanche's starting gun. None of these tell you the date. Together they tell you which act of the play you are in, and in 2000 the people watching the plumbing knew a year before the people watching the headlines. Back to McNeely's question, because it is really an assignment. What were you thinking? Is what every bubble survivor gets asked afterward, and the honest answer is usually, I was not. The crowd was certain, the price only went up. And missing out hurt worse than risk, which, if you saw our last episode, is FOMO running exactly to spec. The dot-com generation was not stupid. They were right about the internet and wrong about price and timing are the whole game. Whatever AI does next, the physics of 2000 still apply. Infrastructure overbuilt with cheap confidence eventually reprices. The technology survives, and wealth transfers from whoever was early and leveraged to whoever was patient and solvent. You cannot control which act comes next. You can control which character you are when it does. So here is the big picture. $725 billion this year, $1 trillion next, chasing a technology that is simultaneously the most impressive product cycle in decades, and an industry earning a fraction of its own build-out. History's verdict on booms like this is consistent. The machines get built, the world changes, and a lot of the money that built it never comes home. The internet was worth every dollar. That did not save the people who paid the wrong price at the wrong time. The same will be true of the machine economy. To be clear, this episode is education, not financial advice. Nothing here is a recommendation to buy or sell anything. So do your own research and talk to a licensed professional about your situation. Next time on Money Machines, the deal of the decade, how Microsoft turned a $13 billion bet on OpenAI into a cloud flywheel that pays Microsoft either way. Subscribe so you don't miss it.